Run your winning trades, cut your losers. And this is one of those trading rules that's pretty obvious. But if it's so obvious, does it need to be a saying? And why should it be that traders find it so hard to live by that? And in fact, they do the exact opposite in practice. Now, first of all, following this day trading rule, it's hard because of the natural tendency to be risky with losses and safe with winners. If you choose to not take your stop, that loss, it's not guaranteed yet. On the flip side, you can guarantee a winning trade by taking yourself out of a positive trade. Laurie Santos, a professor of psychology at Yale, she illustrates this phenomenon superbly in her 2010 TED Talk, which you can find here. When this is coupled with high levels of uncertainty and ambiguity that we experience in the heat of the daily trading battle, you can see that it's easy to convince ourselves that we should bank some profit, or that a big loser might just come back. The markets are full of information, and it's not difficult to conjure signals that are supportive of our positions, and ignore those ones that are contradictory, when really there are none. But there's another facet to this problem. Other traders may well be looking at similar things to us, and therefore they're acting on the same information in a competitive manner. In particular, this can make taking a loss much harder, especially if you hesitate at all. If the market's reached a level where if it breaches it, a cascade of orders flow into the market, a missed exit could mean a far worse price. This in turn feeds the first point, and a trader may well hold on to a trade in the hopes that it'll come back. Now you have to change your mindset. If we look at some trading stats, you'll see why. Your trading stats can be annihilated by just a handful of losing trades, or boosted by squeezing a few extra ticks out of every trade or hitting the odd home run. Let's take an example of a set of 30 trades in the E-mini S&P. You have a 2-point stop and a 3-point target, and your win rate is 60%. This means that on average set of trades, you'll have an 18 times 3-point winners and 12 times 2-point losers. So your average per trade will be 1 point. Now let's say that for the reasons already discussed, in 2 trades in this set of 30, you blow out. You take 1 loss of 6 points and 1 loss of 12 points. It's an additional 14 points of loss in total. Now all other trades are taken as normal. Your average trade now drops to just 0.53 points per trade because of just 2 trades. And this is a fairly conservative scenario of what can happen when traders don't take their stops. Let's now say that on 2 trades, you take an additional 3 points. It's not really a home run there. So that's 2 times 3 to add to your total. So now your average jumps to 1.2 points per trade. That's an improved figure. Confidence and emotional balance can be shattered when you lose more than you know you should, and galvanized by taking significant winners. Emotional strength, it's a depletable resource that is called upon when things aren't going really well. So it needs to be built up and nurtured to make sure that you don't lose control. Over time, having the emotional strength and willpower to continue with your trading plan will help you avoid big losses and trading shocks that go with these. The day trading rule, run your winning trades and cut your losers, it's a very simple one, but it's far from straightforward to live by in practice. Understanding the absolute importance of this rule is the first step to fully embracing it. The next step is to ensure that your trade plan isn't ambiguous for taking stops, and it gives you some room to run your winners. Then, the final step is practice, practice, and practice.